Imagine discovering that €1 billion in your company's bank account doesn't actually exist. A brand trusted by millions for their morning milk and fruit juice was hiding a €14 billion lie? That's not a plot twist in a Netflix drama. That's what happened at Parmalat, once the pride of Italy's food industry. Some call it the European Enron. But in many ways, it was even bigger. Welcome to one of the biggest accounting frauds Europe has ever seen. Parmalat was founded in 1961 by Callisto Tanzi in Parma, Italy. What began as a small family-run dairy soon became a global food empire. By the 1990s, Parmalat had expanded into more than 30 countries. It produced everything from UHT milk to yogurts and fruit juices. In Europe and Latin America, Parmalat was a household name. Its founder, Callisto Tanzi, was seen as a visionary. Parmalat was even listed on the Milan Stock Exchange and held as a symbol of Italian corporate success. Tanzi was hailed as a visionary, admired for his bold expansion into new markets, and even owning Parma Football Club, which won the UEFA Cup in the 1990s. As Parmalat grew, so did its debts. But instead of slowing down or cutting costs, Tanzi and his inner circle decided to cover it all up. They created hundreds of shell companies across the Cayman Islands, Luxembourg, and other jurisdictions. These companies would generate fake invoices, circular loans, and fictitious profits. In one stunning example, Parmalat claimed it had €3.9 billion sitting in a Bank of America account in the Cayman Islands. As regulators, journalists, and banks dug deeper, the scope of the fraud became jaw-dropping. Over €14 billion was missing, making Parmalat's collapse the largest corporate failure in European history. Callisto Tanzi was arrested and later convicted. He admitted to misusing company funds to cover losses and even diverting millions to his football club. His brother, son, and several top executives were also implicated. Over 100,000 investors, many of them small savers, lost their money. And major international banks, including Citigroup and Deutsche Bank, faced lawsuits for allegedly helping Parmalat raise money while ignoring warning signs. So how did this fraud go unnoticed for over a decade? Weak corporate governance, complacent auditors, complex offshore structures designed to confuse regulators, and perhaps worst of all, blind faith in a beloved national brand. This wasn't just about bad accounting. It was about betrayal, of trust, of ethics, of thousands of employees and shareholders. So what's the takeaway? Like Enron in the United States, Parmalat shows that even trusted household brands can hide shocking secrets. Fancy logos and global reach mean nothing without transparency and accountability. In the end, Parmalat wasn't brought down by competitors, but by lies, greed, and a carton full of fake numbers. Always remember, trust but